Hey everyone, Fubo TV stock price is up 42% in the last month, which has a lot of investors asking what's going on with this streaming stock. So in this video, I'm going to go over the big reason why I think Fubo TV stock is up 42% in the last month, and it has a lot to do with what management said in their latest earnings call. So I'm going to review that and let you all know why I think Fubo stock is up so much. So let's get right into it.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now.
So Fubo TV CEO David Gandler said that they delivered 313 million in total revenue, which was up 43% in the most recent quarter, and they increased total subscribers by 20% year over year to 1.477 million. Although that was good news, that wasn't the primary reason why Fubo TV stock was up so much. There was one big thing that caused Fubo TV stock price to increase, in my opinion, and let's build our way into that. Additionally, the company delivered 30 million in revenue from advertising in the quarter. That was an increase of 34% from the same period the year before. Advertising revenue is a big catalyst for Fubo TV stock longer term. It's one way the company can generate profitability because it's not generating profitability from aggregating the content. It's paying too much for the content. That's what we're going to talk a little bit more about. So the company's raising their guidance for revenue for the full year to 1.3 billion, which would represent 34% year over year growth. A little bit disappointing is the subscriber forecast of 1.58 to 1.59 million, representing 10% year over year growth. Although that slower year over year growth was not surprising to me. Ever since the company started raising prices, I was looking for how much subscriber growth would slow down because clearly, if you raise prices, you're going to turn off some customers. I just wanted to see how many customers are going to get turned off from their price increases. I wanted Fubo TV management to demonstrate if they had any pricing power, if there was any reason for this company to reach sustainability. Could they reach that? If they raise prices, could they keep their customers? How many of their customers could they keep? So that's a developing story. It's too early to tell right now, right? They just started raising prices. So we need a few more quarters of the company with these higher prices to see just how many customers stick around. So management reiterating its 2025 target to reach positive cash flow. That was already known to the market. So this is a big thing, but it wasn't the reason why the stock price is up in the last month because this has been known. Management made this target several quarters ago. And so just by reiterating it does give investors confidence, but it doesn't cause the stock price to jump the way it did in the last month, a 40% jump. So management noting that subscriber related expenses or SRE as a percentage of revenue fell to 89%. This was really good news. This is something that management is going to talk about a little bit later in the video, which is going to be the cause, in my opinion, of why the stock price went up so much. Subscriber related expenses is the big thing with Fubo TV. That's the big thing. That's the big story. What Fubo TV does is it aggregates a bunch of content from a bunch of different places, right? Studios, sports, all of it. It brings it together and then it sells it to you, the subscriber, for a fee. But the problem with Fubo TV has been that it has to pay so much for the rights to show that content that the company keeps losing so much money on the bottom line. We'll see just how much money they lost on the bottom line a little bit later. And the difficulty is in achieving leverage in that, right? Because with each new subscriber, Fubo has to pay more in expenses to the studios, to the content owners. The way these contracts are negotiated is not really working in favor of Fubo TV because they're on a subscriber basis. It's not like Fubo TV pays 100 million for the rights to show this content. Instead, it pays a per subscriber fee. So with every new subscriber, Fubo TV has to pay more to the content owners, which doesn't allow the business to create leverage where it achieves profitability. Because every time it gets a new subscriber, its costs go up. Every time it gets a new subscriber, costs go up. And so what I've been calling for with Fubo TV is to raise prices. Raise prices to what they charge customers, even if it causes some customers to leave, so that you can create some difference between what you pay for content and what you charge for content. And so you have a business there where you're generating profit. Otherwise, you don't have a business. If you're paying $100 for something and then you're selling it at 90, you're losing $10 with each sale. You don't have a business. You got to charge 110. Even if that means you're going to have fewer customers, at least the customers that you do have are profitable. So we'll talk a little more about that. The company has $266 million in cash right now, and that's an issue as well. We're going to see how much money the company lost on the bottom line and how much cash it has. Means it doesn't have much runway. It's got to achieve that sustainable level relatively quickly before it runs out of this money. Like I mentioned, Fubo's goal is to be a super aggregator. Just bring together all of this content from various sources and sell it to their subscribers, right? Bundle it together and sell it, right? They're not trying to create any content. They're not a content creator. They're a content aggregator, okay? Which longer term does not bode well for profitability and profit margins, because there's only so much you can profit if you're always having to pay someone else for the content. Because when things go well and the demand for content increases, those content owners can always increase prices that you have to pay them. And so you're never in control of your own destiny because you're always having to pay someone else for that content. Now, the goal is that if Fubo TV reaches a certain scale, let's say it reaches 10, 20 million, 50 million subscribers, it can then exercise some negotiating power against those content owners. But that remains to be seen, right? I give an example sometimes of Netflix, which tried that same strategy. They thought when they reached a few 100 million subscribers, they would have more negotiating power with the content owners. But instead, what ended up happening is the content owners just told Netflix, you know what? We're just not even going to sell you our content anymore, regardless of how much you want to pay us. You're trying to get a better price for our content. We're not even going to sell the content to you. And so Netflix had to pivot and start to create its own content to fill the platform because owners weren't selling that content to Netflix anymore. So is Fubo TV going to face that same situation, or is it going to be able to negotiate better prices? That remains to be seen. That's a big question mark. So thankfully, Fubo TV has been raising prices, and that helped average revenue per user in North America reach $83.51. That was good news. That's a good start. Fubo needs to go further because even at this average revenue per user, the company lost, we're going to see just how much money they lost on the bottom line. So even after raising prices, they're still losing money on the bottom line. They need to go further. So the net loss came in at 84.4 million in the quarter for Fubo TV. So I would suspect they need to raise prices by at least another $10 per month to approach profitability, and perhaps even $15 or $20 per month to reach profitability. That remains to be seen, but they just got to keep going because 84 million losses on the bottom line, and we saw earlier how much cash they had. They ended the quarter with 266 million in cash. So you can do the math here. If you're losing 84 million every quarter and you have 266 million in cash, that leaves you 3 or 4 quarters of runway before you run out of this cash, right? So you've got to sustain the business model. You've got to sustain the business. You got to put it on sustainable footing sooner rather than later, because investors are becoming less tolerant of these kinds of companies that are losing money on the bottom line. If Fubo was to go back to investors and say, we need more money, Fubo is going to have to pay a higher cost of equity or higher cost of debt in order to get that money from investors. So it's got to get itself self-sustaining level, right? Not going back to investors and asking for more money. So here's the thing that I think caused Fubo TV's stock price to jump by 40%. Management saying, as we continue to grow subscribers to optimize our pricing, we expect to see continued leverage on the SRE line. And remember the SRE line, the subscriber related expenses. The big problem with Fubo stock, the thing where smart investors, analysts know about Fubo TV is this leverage, right? That gap. They need to create a gap between what they charge customers and what it costs them to serve that content to customers, and that shows up in the SRE line. In my opinion, it's the most important metric to look at with Fubo TV stock. And so what management is saying is we're going to see a greater gap open up in this metric. That's what management said in this statement here, and that's what really got investors enthused and said, okay, maybe there is something with this company. Maybe they can create that spread and actually operate this business in a way where they pay $100 for content and they can sell it for 110 or 115 or 105, whatever it is, as long as it's above the 100 that they're paying and enough above the 100 that they're paying. Remember, they've got a bunch of other expenses as well. They got to pay for corporate headquarters, the CEO, the CFO, everyone needs a salary. So it's not just got to be a little bit above, it's got to be a good amount above what they're paying for the content to operate the business sustainably. And this is what got investors encouraged about the company, about its potential to actually just survive on its own without needing to go back to investors and ask for more and more and more money. It can just operate, sustain itself, and slowly grow and capitalize on the trend, because remember, people are cutting the cord on cable, and if they still want a bundled service, then they've got to go to one of the streaming providers, which there are a few. Hulu Live TV from Disney and YouTube Live TV are competitors to Fubo TV, but Fubo is sports centric, which attracts a certain kind of customer, which helps Fubo TV. So they can capitalize on that tailwind, but they've got to price the product appropriately, and they've got to realize that we can't grow the way we were in 2020 and 2021 and 2022 if we are to operate the business sustainably, if we are to self-fund the business. So because of those price increases, we've already highlighted subscriber growth has slowed down. For North America, it's only going to grow 10% for the year. And for the fourth quarter, they actually expect a decline in the rest of the world segment, 7% year over year decline. That's okay. The rest of the world segment is a small part of Fubo TV's business. They generate a smaller average revenue per user. But this is just starting to highlight that subscriber growth is going to slow down. That's inevitable if you're going to raise prices. But as investors, as Fubo stock investors, it's important to watch that difference between Fubo TV raising prices, creating leverage in terms of their SRE line, the subscriber related expenses, and at what cost does that come to? How many subscribers will they lose? Or will they just remain flat? Or will there be any more subscriber growth? So can they create leverage in the subscriber related expense line enough so that they can operate the business sustainably, and at the same time, can they keep their subscribers or even grow their subscribers? Or at these higher prices, will subscribers say, you know what, no thank you, we don't want to pay for Fubo TV at these prices? So that's the big question mark. That's what I've been following with Fubo TV over the last several years, and that's what I think Fubo TV stock investors should continue following. And this is why Fubo TV stock is up 40% in the last month, because of progress on that front, on that subscriber related expense front. I hope you enjoyed this video. It's important not to underestimate the value provided in these free financial analysis videos. To keep the content free, I need your support. All it takes is a smash of that subscribe button to tell YouTube that you want to keep this channel alive. So hit that subscribe button, and thank you for your support.